started with your first financial plan, we want to congratulate you all for completing 14 hours of financial learning and reaching this step. You've really taken a huge step to learn about your own money, to know how to put it in place and to make your investments and finally creating wealth for you. We couldn't be more proud of you, and you should also be proud of yourself. We may like it or not, but money definitely becomes the stepping stone to a lot of goals in life, and when that is achieved, or we are on the path of achieving that feeling cannot be compared to anything else. So once we've done all the goal settings, financial discussions and jargons, here we are, and in this session and the following session, we are going to run through 2 financial plans for you. Basically, the journey of 2 individuals who are at different phase of their life and careers, and how they can use their money to put everything that we've learned so far in place. So basically, after all the theory and numbers, we're finally going to learn how to practically apply everything that we've learned so far for you in your numbers. So to start this financial plan, we've taken the case of Leila, who's a female who's just started working at the age of 23 as a graphic designer with a marketing company. She is from the city of Mumbai and lives with her parents and is very excited to get started with her financial plan. And obviously she has attended our workshops and our courses and is slightly aware of how to make the most of our money, and now she's looking to put it in places as we've discussed in the courses so far. So the first step for anyone, including Leila, is to understand her cash flows. So where she's making 50,000 rupees per month, that is her CTC. So the first thing to know is how much would she get in hand. So we know that out of 50,000 rupees, 200 rupees is going towards her profession tax and 6,000 rupees is going as employee provident fund. So we've discussed in detail about employee provident fund in module 1 session 5. So we know that Leila has got income in hand of 43,800 rupees, and this is the money that she has to eventually spend and invest across various things. So if you remember our discussion from module 1 session 1, we established that what should be your benchmark savings. If you do not have anyone who's dependent on you, you're not paying rent and other living expenses, then you can save up to 60 to 70% of your take-home income. And if you have, then you should try and save 30 to 40% of your take-home income. Given Leila is living with her parents who take care of her rent and living expenses, she does not really have anyone who's financially dependent on her, she can freely save 60% of her take-home income, that is 26,000 rupees, and she has in hand 40%, that is 17,800 rupees to spend on various things. So to see Leila's lifestyle, where she does not really have to pay for anything, 17,800 rupees towards commute, shopping, food and any other things are good enough amount, and she's also saving 26,000 rupees per month. So as we've already discussed, you have to pay yourself first. So Leila has 2 bank accounts. The first bank account is her salary account or income account, in which 43,800 gets credited. Out of this, she saves first into the second bank account, her ICICI account, in which she transfers 26,000 rupees per month, and the balance 40%, that is 17,800, is there in her HDFC bank account, and she can spend that money. So after her savings are taken care of and she has split her money across 2 bank accounts, now she has to focus on the money in her second bank account, that is ICICI account, and start converting his savings into further investments and make her money work hard for her. But before that, before you start looking for your goals and investing for your goals, the first thing to do is to build up your safety net. That is, provide for her contingencies. And what are the 3 contingencies that we learnt about? Emergency fund, life insurance and health insurance. So first let's take care of her 2 insurances. She shall first get a term life insurance to protect herself from any untimely death and ensure that the rightful amount goes to her parent in current scenario, and she's protecting herself financially from any uncertain health issues by getting a health insurance. So how much life insurance should she take? We know that her annual income is 6 lakh rupees. So by going by the first rule of computing life insurance, that is underwriter's method, she decides to get 12 times of her annual income, that is sum assured of 72 lakhs. So she will get a life insurance policy for 72 lakhs. Now why is that so? As we discussed in module 4, session 2, life insurance, that under underwriter's method, you get an insurance of so much amount that it replaces you financially. So this 72 lakhs when her family members would get, they can invest at 8% per annum, which would approximately give them 5.76 lakhs per annum, that is per month 48,000 rupees. So she is basically being replaced financially appropriately through this life insurance plan. And how much should be her health insurance? If she is staying in a tier 1 city or a metro city, it should be 10 lakhs. And if she is staying in a tier 2 cities, then it should be 5 lakhs. Given that she is from Mumbai, which is a tier 1 metro city, her health insurance sum assured would be 10 lakh rupees. So she goes online and checks the right insurance for her. She takes a term life of Bajaj Alliance, where her premium of insurance come to 6,681 rupees. And she gets a health insurance of 10 lakhs from Star Health, and there her premium for the entire year comes to 7,432 rupees. So she knows that she has to per month keep aside 1,200 rupees approximately for her insurance needs. So she has taken care of 2 major contingencies. Now let's get started with the third contingency, which is your emergency fund. Now the first thing to set up is an emergency fund. So we shall plan her emergency fund as a goal along with her other goals, so that when she's doing financial planning, she can just put emergency fund as first goals. So once her contingencies are taken care of, let's move on to investments and how she's going to invest her money. So if you are with me so far, you would have understood that she had 43,800 rupees in hand. She transferred it to 2 various bank accounts. Income account where she continued to spend her money from, and her savings bank account. Now from these saving bank accounts, she bought 2 insurance policies, 1 term plan and 1 health insurance policy. She's going to spend on them monthly around 1,200 rupees. Now once her safety net is in place, she can start climbing higher, and to do that, she is going to make her investments. So before you go ahead and make the investments, the first thing that you need to do is know how much return you're going to generate from the investments. Which is the best product for you? Which is the latest trending product in the market? No, right? None of these. The first thing to do is to know your risk profile. Correct. So Leila goes through the risk profile tool, which we've discussed in module 3 session 1, and she answers all the questions and comes to a conclusion that her risk profile is growth. How do you determine your risk profile? It is based on her ability to take risk and her willingness to take risk. ability is determined by your age, how much wealth you have, and what is the urgency of your goals. And your willingness is basically how comfortable you are to take risk, how willing you are to take that risk, and is subject to your various life experiences, how you're brought up, and how you perceive risk with your investments. It's basically based on whether you're an entrepreneur or an employed individual, your sources of wealth, and your various life experiences. So based on the tool, we conclude that Leila is a growth profile, which basically means that her asset allocation would be 70% in equity and 30% in debt. So her expected rate of return from the portfolio would be 13.2%. So we've discussed about her asset allocation and expected returns from her portfolio in module 3, session 2 and 3. So once she has this in place, the next step for her is to determine what are her goals and how she's going to invest for her goals. So let's list down your goals. The first thing to go about investing is to first make a note of her goals. Second, write down the amount she would need for the goals today, and then the tool, your goal setting tool, will give you the money that you need for the goal in future and will also help you realize how much SIP you need to set today. So the next step for Leila is to get investing, and to do that she needs to list down her goals and go to the goal setting tool and write down the amount of the goals, the tenure in which she wants to complete the goal, and the goal setting tool will give her the future value of those goals. So what are Leila's goal? As we discussed in the contingency section, her first goal is to set up an emergency fund. Then she wants to travel yearly. She's finally independent, making her money, so she wants to explore as much as she can. She wants to pursue higher studies. She is like in the next few years, she wants to go and do a post-graduation in marketing. Then she is also setting aside for her wedding fund. She does not want that her wedding becomes a huge liability on her family members and wants to set aside her own money for that. And of course, the most important goal is financial freedom. And from our discussions in module 2, session 6, she has established that financial freedom is extremely important, and she wants to start investing a portion of her savings towards that from her first investment. So let's compute the value of her goals. First up, emergency fund. As we just discussed, that emergency fund depends upon how much financial responsibility you have and other living expenses to take care of. Where you do have these, your emergency fund should be 6 to 7 times of your monthly expenses. Where not, then 3 to 4 times your monthly expenses is enough as an emergency fund. So given Leila does not really have any such responsibilities, her emergency fund is 3 times of her monthly expenses, that is 17,800, which comes to approximately 50,000 rupees. Now she already has an existing savings of 50,000 rupees, which she is keeping towards her emergency fund. So she does not have to invest monthly for her emergency fund. This 50,000 rupees is kept aside in a fixed deposit, which is linked to her ICICI bank account, which is her investment account for any kind of financial emergencies. So now that her emergency fund is out of the way, she starts computing the future value of her other goals. She wants to travel next year and explore different places. So she wants 50,000 rupees, and the future value of that at 6% inflation would be 53,000 rupees. Her next goal of higher studies, we already discussed in the goal setting session that for education we are considering an inflation of 10%, and so her future goal value would be 10.5 lakh rupees. For her wedding fund, she's looking to get married in the next 8 years when she reaches the age of 30-31, and the value of her goal would be 12.75 lakhs. and her last goal, which is financial freedom goal. Now let's quickly go through the financial freedom tool to understand how has she arrived at the amount of 2.72 crores. So when we go through the tool, we see that her current age is 22. She is expecting to retire at 50. She is looking at an early retirement. Her life expectancy is 85, an inflation rate of 6%. So her monthly expenses of 20,000 rupees today comes to approximately 1 lakh rupees at the age of 50. So yes, your financial freedom number would also change as your lifestyle changes. So you start investing for your financial freedom goal as per your current lifestyle and expenses, and say 5 years down the line she has more expenses, then she would need to reset this goal, add on these numbers and then start investing accordingly. So it's not that you're done with these tools for once and for all. Every year you need to revisit them. So her corpus required at retirement comes to 2.72 crore, considering that she would invest the amount at a conservative rate of 9%. Now this 2.72 crores is her goal value for financial freedom goal. So once her goals are in place, the future value of the goals are in place, the next step is to invest for your goals. And if you recollect from our earlier discussions, how do you invest on your goals? You invest in your goals as per the duration of the goals. So where your goals are for less than 3 years, you invest all the money in debt products, and where your goals are for more than 3 years, you invest in a mix of debt and equity as per your asset allocation. So what are her short-term goals? Her short-term goals are her emergency fund and yearly travel, and all her other goals like higher education, wedding fund and even financial freedom is a long-term goal. So she would invest in them in a mix of debt and equity in the ratio of 70% in equity and 30% in debt, because she is a growth profile. Now you need to check if there are any existing savings and adjust that with the future value of her goals. Now as we said, she's just starting out. She doesn't really have any savings as such. Whatever she had, she has parked it aside, her emergency fund, and taken care of that. And for all her other goals, she needs to start investing afresh. So let's quickly look at the number or the amount she has to invest. She has her total savings of 26,000 rupees and her EPF. Yes, so the amount that is getting transferred from your salary each month towards EPF is also your investments. So that will get added to your savings and you will come at an amount of 32,000 rupees. So her entire corpus that is available to her each month is 32,000 rupees. So she has to assign this 32,000 rupees towards her goals. So first thing she does is, out of these 32,000 rupees, she'll put money aside for her short-term goals. So emergency fund is taken care of. Your insurances are taken care of. So she will put 1,200 rupees per month aside for her insurances, and then she will know how much does she need for her yearly travel. So if you go to the goal setting tool, you can see that she needs 4,000 rupees to be kept aside per month to achieve her travel goal. Going forward, all the numbers that we're going to discuss are rounded off so that it's easier for you to understand the concepts and how her financial planning is done and how do you allocate your investments towards your goals. So we know that for her short-term goals, she needs 5,200 rupees, 1,200 for her contingencies and 4,000 for her travel goal. So now out of 32,000 rupees, 5,200 is taken care of. She is left with 26,800 rupees. Now this is the amount that she has to invest for her long-term goals. Now we know that for her long-term goals, she needs to invest in a mix of debt and equity in a ratio of 30% and 70%. So 30% of 26,800 is 8,000 rupees, which will be invested in debt, and in equity 18,800 rupees. So let's see how much would she need for each goal for her long-term goals. Now, as per the goal setting tool, so for her education she needs to keep aside 12,500, and for her wedding goal she needs to keep aside 7,500, and for her retirement goal she needs to keep aside 6,800. And because the tenure of all these goals are for more than 3 years, she can invest in a mix of debt and equity. So let's quickly look at how she will invest. We know that after removing 5,200 from her amount available for investments of 32,000 rupees, she has 26,800, out of which 8,000 goes to debt. Now out of this 8,000, 6,000 rupees is already going to her employee provident fund. So that is her debt allocation. Balance 2,000 rupees she would allocate towards a short-term debt fund. Now out of 8,000, balance 18,800 in equity can be split across 5 equity mutual funds in equal proportions. So 3,760 rupees to be precise can be put in large cap and mid cap mutual fund, small cap mutual fund, and a thematic mutual fund. So she can put aside these amounts in equal proportion across these funds. We would advise that you go for thematic mutual fund only where you have better understanding of that particular market sector and you have a better risk-taking capacity, because thematic mutual fund is a more concentrated exposure to a particular sector and a better understanding is required over there. So by now she knows that where she has to invest her money and how she's going to achieve her goals. So basically she has put her money across various investments in the ratio of 30 and 70%, and then she has mapped them to her goals as well. Now before we quickly revise all these numbers, quickly going through the tax planning. I'm sure you would have the question that why are there no taxes for her? So let's have a look. Her income as per her CTC was 6 lakh rupees, and from that she gets a standard deduction of 50,000 rupees. So if you remember from our discussions of module 3 session 8, every salaried individual gets a standard deduction of 50,000 rupees irrespective of their components in the CTC. So that is gone. Then she's also contributing 6,000 rupees per month to her employee provident fund. So that gets covered under section 80C. Then she has also got a term insurance plan that also gets covered under section 80C. Now if you go and see, her salary is not very high that she has to go out of her way to invest 1.5 lakh rupees in 80C. She should only invest to the extent that is required. So hence 78,621 is invested towards your 80C deduction. She also has a health insurance policy of 7,432 which she is paying for herself. Now because she is not completing the 25,000 limit that is available, she can also claim 5,000 rupees deduction towards preventive health checkup. I'm sure in a year we do take certain health care, and so she gets a deduction of 12,432 for that. So overall, after claiming all these deductions, her income from salary comes to 4.5 lakh rupees. Now as per the income tax laws, where your total taxable income is less than 5 lakh rupees, then you don't have to pay any taxes, because you get a basic exemption limit of 2.5 lakhs, and for your income from 2.5 to 5 lakhs you get a rebate of 12,500 rupees. So basically any taxable income below 5 lakh rupees is tax free. We've understood how Laila's money is flowing. Let's quickly look at the final flow of her investments so that you have understood very clearly how her money has flown from her income to her final investments. We know that Leila CTC is 6 lakh rupees, that is her monthly income is 50,000 rupees. Now out of that, EPF and taxes of 6,200 rupees are going, so she has 43,800 rupees in hand. So the first question that comes to her mind is, what next? How much should she save? So that is the first decision making place where you have to go back to your learnings and be like, okay, no dependence, so I will save 60% of my income and I will pay myself first, so have 2 bank accounts. So she puts her savings aside first, which is 26,000 rupees, and then removes her expenses of 17,800. She is free to spend that money as she wants, but she cannot touch her savings. So this savings of 26,000 rupees and the EPF that her employer is putting aside combines together, and she has that much money to invest. So she basically has 32,000 rupees to invest. So what is this? This is a decision making place, because she needs to know where she invests, and the first step to taking this decision is to knowing her risk profile. She goes through a risk profile and knows that it's a growth profile with 13.2% ROI. So once that is in place, she starts putting her goals. But wait, what's the next step? She needs to put her contingencies aside. So her emergency fund, life insurance and health insurance is first kept aside. And then she puts aside her short-term goals and her long-term goals. That is, she lists down her goals, the amount of those goals, and arrives at how much she needs to keep aside for her goals using the goal setting tool. So we know that she needs 5,200 for her short-term goals and 26,800 for her long-term goals. With higher studies, she's keeping 12,500, wedding fund 7,500 and financial freedom 6,800. So her short-term goals are very straightforward. She keeps that money for insurances. She either pays monthly or she keeps that money into a liquid mutual fund and pays annually. For her short-term goals, she puts that money aside in a short-term debt fund. Now, what does she do for her long-term goals and the balance of 26,800? She is now going to invest that into a ratio of 70-30% and based on her risk profile. So for debt, she transfers 8,000 rupees, and for equity, she's going to transfer 18,800 rupees. Now we've already discussed that of debt, EPF and short-term debt fund takes care of it, and out of her equity portion, she splits that money across 5 different funds of 5 different categories and in equal proportion. Now once her financial plan is in place, all her numbers are done and we've done to the financial plan. Is this it? Is she done? Not really, because you keep changing your income, because you keep growing in life, your goals change, your income change, your monetary needs change, and hence your financial plan also has to change. So after putting this entire financial plan in place, the next step for you is to review it every year. You should review it at least once a year, where you do this entire process from end to end. That is, you take your money, look at your expenses, put your savings in place, look at your investments and allocate your money properly across everywhere. So finally, by putting this financial plan in place, Leila is just not providing for her immediate expenses, but is also working towards achieving her dreams and her goals. She is having that travel every year and also putting some money aside for her higher education. So she is ensuring that her needs and desires do not become a burden on her parents financially, but she is also contributing towards that. This entire financial plan helps her to live her lifestyle comfortably and also achieve her short-term goals, and she is also able to realize her dreams and spend all the money that she has either for some immediate needs or for her future goals. And this is how beautifully your financial plan can put your desires in place. So we hope that this financial plan gives you an understanding that putting your money in place is just not about saving and investing, but it is about having enough that it gives you the choice to go for that travel every year, have the wedding of your dreams on your own, and also looking at being financially free at an early age, just like Leila did. So we hope that through this you will get working on your numbers and will also set your own financial plan. In the next session, Harsh will come and discuss about the financial plan of another person who has some more years of experience, and hence there are some complications to his plan. He has certain existing investments, so how to park those investments properly, and we shall discuss about few case scenarios that you may come across when you're doing your financial planning. So the next session is on the second financial plan of an experienced person.